subscribe now and press the bell icon. Never miss an update.
Okay, so we need to start with section 1231, right? Before that, does anyone remember what is 1245 for and 1250? One person. Vandana, do you know what is section 1245?
Is it for depreciation, recapture for real properties and non-real properties?
Okay, so yeah, that's what it is. And if we don't remember, we can just go over that again. The 1250 is pretty much related to any real estate. Both of them can be depreciable. 1245, 1250, but there are certain more advantages if it's a real estate property, and 1245 is applicable to any other property, which could be intangibles as well, or furniture, equipment, and other things. And then we started with section 1231, which, if you guys remember, what does it say? Best of. So basically, the losses can be treated like ordinary losses, gains can be treated like capital gains. So that's best of both the worlds, right? So let's get started on that now. Okay, so unlike the recapture provision, section 1245 and 1250, section 1231 is beneficial to the taxpayer. We have already seen that it's like best of both the worlds. This is really what one should aim for, or one should plan for, how to get the section 1231 gains. And there's certain couple other rules. Let's go over that. When section 1231 gains exceed losses, if there are multiple properties, if the gains are exceeding losses, a net section 1231 gain, each gain or loss is treated as being from the sale of a long-term capital asset. So the gains can come up as long-term capital asset. And if the losses exceed gain, we can take those losses as ordinary loss. Okay, that can give tremendous, a huge advantage to any taxpayer if they are able to take the losses as ordinary losses, because that can reduce their other income, which is going to be taxed at the highest possible rate, and the gains can still come up at very special rates of capital gain rate. Section 1231 property is always long term. It has to be held for more than 1 year. Okay, it could be any real or depreciable property. It could be even converted capital assets, like involuntary converted and all. Maybe a lot of times, maybe, so section 1231 is pretty much any property that is held for more than 1 year. And we always know land is not depreciable. So we are not talking about any depreciation, recapture on land and all those things. Land is referred to as pure section 1231 property if used for trade or business and held for more than 1 year. Okay, so now let's look into, we'll go through some of the examples that will really make it clear. But what they're saying is, we know this, right? Section 1231 has to be an asset. It cannot consider inventory as section 1231 property. We cannot take any personal use property. Personal assets are different. When we are talking about personal properties, those are different. In the context of 1245, section 1245, we said that there could be personal properties and all, but I'm not meaning that individually held properties and all, or personal use property. Those are still business use property. So section 1231 is not applicable to personal use property. And inventory is not even it could be an asset. It is a current asset. It's not a depreciable asset. It can be written off. It can be it can be like obsolete and all those things, which is a different thing, but it's not a asset that gets regularly depreciated and all. Section 1231 has a two-step test. First of all, the step one is we just have to see what is the net gain or loss from all casualties or thefts. Any kind of casualty has happened, any kind of natural, due to natural cause or some calamity that has happened, earthquake or tornadoes, hurricanes and all, which is not in the control of the business. or thefts, even that could be non-controllable. So in that case, the rules are slightly different. What we'll do is we will take all the net gain or losses and any involuntary conversion, that means the business it doesn't have a choice, they just have to convert their property into something based on some ruling or some notices and all, and they may have to bear some losses on that. Okay, so let's just see this. If we are taking all the net gain and loss from casualty or thefts, and if the result is a net loss, okay, each gain or loss can be treated as ordinary income. If the result is a net gain, then what they're saying is you go to step 2. If it's a loss from any of the casualty and theft, just straight away go and take that as ordinary loss, even if it is coming from a capital property. But if it is a gain, then they want you to go to step 2 and then see where the gain is coming from. Okay, determine net gain or loss from all disposition of section 1231 property, including the property in the first step. So in the first step, all we are taking is only property which is related to casualties or thefts and all. Everything else will come in the second step. Again, if the result is a net loss, we will take that as ordinary income or loss is a gain. If it's a gain, then each gain or loss is treated as long term, subject to the recapture rule. There can still be recapture. What we have seen is that recapture happens only when there is a depreciation. Then only we'll just talk about, okay, because recapture is taking that amount again and putting that for tax purpose, capturing that amount. Let's go over this example. Shweta, can you read 10.5?
A business taxpayer sold for scrap outdated equipment purchased years ago. The equipment had an adjusted basis of $5,000 and a sale price of $2,000. Business equipment held longer than a year is Section 1231 property, and when sold at a loss, the loss is ordinary income, not capital gain. If this business had $10,000 taxable income from operations and no other transactions, its taxable income for the whole year would be $7,000. That is $10,000 taxable income minus $3,000 losses.
So we are assuming no other complication in that situation. We are assuming this is a straight 1231 loss on sale. And the example, what it is saying that if you are having some other ordinary income, you can take that loss, which is on an equipment. So it's technically it's a capital loss, but since it is section 1231 property, we get a benefit. We can take that loss and we can try to reduce ordinary income. So now the tax liability will straight away be, $3,000 is straight away reducing the taxable income. So obviously the tax liability will be less on the lesser amount. Okay, I hope this is very clear because all it is trying to tell you is this can be taken as an ordinary loss. Okay, allocation. What is allocation? Allocation is required when section 1245 or 1250 property is also section 1231 property and only a portion of gain is recognized and all those things. So when there is a section 1245 property or 1250 property, 1250 is like real estate and all, 1245 is other property. This is also section 1231 property, meaning that it is probably held for more than 1 year and all, because section 1231 is all long-term property. And only a portion of gain recognized is section 1245 or 1250 ordinary income, OI. We'll go over some of the example. If I read like this, it could be a bit confusing. The installment method can apply to section 1231 property. What they're saying is fine if there is an installment sale, that meaning not all the money is coming in one shot, we can still apply the rule of section 1231. Recapture, how does the recapture happen? Net gain on section 1231 property is treated as ordinary income to the extent of unrecaptured, like this is the word that I want to highlight. Unrecaptured, meaning this is not put up as a taxable income again. Some point in past, deduction was taken, but it is not recaptured. So unrecaptured section 1231 losses from preceding tax years. If there are losses from preceding tax years and we have not done any recapturing and all because we could just like reduce the loss and all, later on if there is a gain in subsequent year, if there is a gain, then to the extent of these unrecaptured losses, we will reduce that gain and we will take this past amount, this previous year's unrecaptured amount, as ordinary income. This is not happening, when the property is being sold. Maybe in the past, maybe 3 years back, we've sold the property. That time the recapturing did not happen. But later on, again, if you're selling a 1231 property, now we are having a gain. So what IRS is saying that, okay, you go back 5 years. They're not asking you to go back indefinitely. See what were the losses for last 5 years. See if there is something that is eligible for recapturing. And that amount should now be considered as an ordinary income. So basically, if you are having an income, then you split up a portion of that into ordinary income and portion of that into capital gain income. Only if there are any other unrecaptured losses from prior years. Okay, let's go over this example. So, who can read this? Bhavani?
Yes. Section 1231 recapture. Eric has unrecaptured Section 1231 losses of $4,500 from 2 years ago. This year he has a net Section 1231 gain of $7,600. Of this gain, $4,500 will be recategorized as ordinary, and the remaining $3,100 will be classified as long-term capital gain.
Anya, can you please go over that?
So his 1231 loss is 4,500. According to the rule, whatever loss that is there under 1231 can be claimed against an ordinary loss. So 7,600 minus 4,500 will be recategorized as ordinary, and the remaining will be long-term capital gain.
Yeah, what is more important is this is unrecaptured losses in the prior years. They had taken advantage of these losses as ordinary loss, and now they're having a gain. So now what IRS is saying that, okay, these were unrecaptured, nothing was captured, nothing was recaptured as ordinary gain. You've already had full advantage. So now when you're having gain, at least make sure that prior year, whatever losses were there, they need to be considered as ordinary income. Obviously, whenever we say ordinary, the tax will be paid higher on this amount. And the remaining can be classified as long-term capital gain. Okay. It's and see, these rules are all for businesses. It's very important for business to keep their entire data intact properly. The work papers should be really neat and clean, so anybody can go back 5 years and understand what has been done earlier. Were there any 1231 adjustments that were done, or any losses or gains taken? Business, it's a responsibility on business to make sure that they're keeping their accounting very clean, and all their tax calculations and all. So that's why, like, whenever we are also preparing our work paper, we have to really do a very good job, because we don't know, it's a business, it's not an individual. There is a lot of responsibility on the business. Everything needs to be, the entire onus lies on the business to prove what they have been doing. So, okay, let's go ahead. Section 1231 merely characterizes gain or losses. So what they're saying is, again, now this is a rule that we should remember. Any section 1231 gain that is recharacterized as capital gain will first consist of 25% gain. and then it will go to other categories. Again, there is an example, we'll go over that. Section 1231 gain, first we'll have to consider what goes in the 25% bracket and then others. So when sale price is above the cost of the asset and no losses exist in the current year or preceding years, okay, we are assuming there is nothing, no other complication, just simple sale price is more than the cost, then section 1231 gain is characterized as ordinary income as depreciation is recaptured and capital gain for the remaining amount. Let's go over this example. Now, Hemant, 10.7.
ZP Enterprises purchased a delivery truck for 100K more than a year ago, and it was fully depreciated truck. Uh, and ZP Enterprises sold a truck for 120K dollars, and this year resulting 120K 100K section 1231 gains. The character of the 120K gain was as follows: ordinary income was 100K, and 2000 section 20,000K section 1231 long term capital gains, and 120K as a total gain.
Okay, so simple things. It was purchased for $100,000 more than 1 year ago. So we know this is not a short-term asset. It is fully depreciated. Maybe it was section 179 and all. Complete depreciation was taken. So now the basis goes to zero. And ZP Enterprises, they want to sell off the truck for 120,000 this year. So what they're saying is we need to 100,000 will be captured again as ordinary income because the entire deduction was given earlier. 20,000 will be taken as section 1231 long-term gain. Okay, this is the recapture. This is an example of recapture. All right. Let's
Yes, ma'am.
let's go to installment sales. Any installment sale, and also we have to use the same kind of principles or rules here. Any gains realized from disposal of recapture property in an installment sale. Again, if we have to see what is ordinary income by section 1245 or 1250 and must be recognized in the period of sale. So what they're saying is whatever that ordinary income portion is, that you need to recognize in the period of sale only. Other gains we can spread out because this is an installment sale. So excess gain over ordinary income is accounted for by the installment method. So we can use the installment method. We can spread it out. We don't have to take all the gains in the very first year because it's an installment sale. The money will be received over a period of certain time, which could go beyond 1 calendar year. Okay, any gifted property, well, none of that will apply to gift disposition. Whenever we are gifting a property, whenever the property is being inherited, this does not apply. But any subsequent taxable disposition, if that it's a gifted property, if that property is converted as a business property, later on, if it is being sold out and all, definitely section 1245, 1250 needs to be thoroughly analyzed and see if they have any implication. Again, section 1245 inherited property, none of that will apply, but there are certain exceptions. They're saying in this case, if the person has died and there is some income in respect of a decedent, IRD, we have seen that. So the income in the year in which the person has died and all, and that income is directly related to the person who died, then that income will be characterized like the normal rules will be applicable because this is not an inherited income. That has to be taxed for as an income of that person who is dead now. And again, Section 1245 ordinary income, it results from depreciation allowed to decedent. Any depreciation that has been allowed to decedent, meaning the person who has passed away, any depreciation it was, if it was allowed to that person, then we again have to see if ordinary income rules will apply, because the depreciation will not carry over to the transferee. It is an inherited property. Somebody else will inherit it and all. But if there was some depreciation taken earlier, we'll have to see if 1245 ordinary income come into the picture. Let's look into section 351. This is again very, very popular section. A lot of our clients have used this section to do a conversion, or do like some sale kind of thing, or close down one company, had another company, and there was exchange of stock and all. Section 351, exchange for stock. Usually this is not a taxable transaction. Old company stock is being exchanged with new company stock. Usually there's no gain recognized, and section 1245 and section 1250 ordinary income is limited to any amount of gain recognized in a 351 transaction, which is fine. If there is a transaction which is probably not done at proper fair market value and all, if it is resulting into any section 351 gain, then if there is a gain in 351 transaction, then we'll have to see whether ordinary income is there or not. But usually there is no gain recognized. Section 1245 applies to the amount of gain recognized plus the fair market value of non-section 1245 property received. This, we will go through this example and we'll see this. So what they're saying is, any gain which is recognized, obviously we will use section 1245 if it's a personal property. Any fair market value of non-section 1245 property if it's received. Boot meaning cash. Cash is not a section 1245 property. But if there is some exchange happening and they are giving up this property and getting some other property, in lieu of that, which is not the same nature property, okay, then we'll have to recognize the gain and we'll have to follow certain steps. Section 1245 will be applicable to that kind of property. Okay, let's go over this example now. Who wants to read this? So, Varunji, why don't you read section 1245, recapture?
Yes, ma'am. Section 1245 recapture. On January 17th, year 1, Relief Corporation purchased and placed into service 7-year MACRS tangible property costing $100,000. On December 21, year 4, Relief Corporation sold the property for $105,000 after taking $60,000 in MACRS depreciation deductions. The adjusted basis of the property is $40,000, that is $100,000 historical cost minus $60,000 depreciation. Therefore, Relief will recognize a gain of $65,000, that is $105,000 selling price minus $40,000 adjusted basis. Since this property qualifies for section 1245 recapture, the gain is recaptured as ordinary income to the extent of the lesser of all depreciation taken or gain realized. Thus, Relief will have $60,000 of section 1245 ordinary gain. The remaining $5,000 of gain is section 1231 capital gain.
Tanya.
The cost of the property is 100,000. It is sold for 105,000, and the marks depreciation claimed is 60,000. So the adjusted basis of the property is 40,000. And then that's why, based on that 40,000 cost, the actual gain comes up to 105,000 minus 40,000, that is 65,000.
Right. So because selling price is 105,000, obviously basis is only 40,000 because 60,000 has been taken up as depreciation. So now the total gain what we know is 65,000. What is more important to understand here is how this total gain will be taxed in the hands of Relief Corporation. Can we take entire gain as capital gains and just put like 20%, 25%, get done with it?
No.
No, because there is a depreciation which has been claimed earlier. So we have to look into the recapture rules. This is a business property. That's why the recapture rules come into the picture. How much can we take as ordinary income out of
The
this? Yeah, go ahead.
the lesser of depreciation or the gain realized. The depreciation is 60,000 and the gain realized is 65,000. So you'll take 60,000 as a section 1245 ordinary gain, and the balance 60,000, 5,000, that is 65 minus 60, will be capital gains.
Yes, it's very important to know because we don't want to make any mistake here. It can 60,000 at capital gain rate will be a completely different number. 60,000 at ordinary gain is going to be very, quite significantly higher in terms of tax liability. Okay. So now let's continue with this example. So Tanya, you can continue. Now the situation is a bit different. Here we sold the property for 105, and here the property same, everything is same, except that the property is sold for 95,000. So now, Tanya, go ahead and can you read this
The
second?
facts from the example 10.8 apply, except Relief sold the property for 95,000. So Relief recognizes a gain of 55,000. That is 95,000 minus 40,000, the adjusted basis. Since the property qualifies for Section 1245 recapture, the gain is recaptured as ordinary income to the extent of lesser of the depreciation taken or gain realized. So depreciation taken is 60,000 and gain realized is less than that. So the whole amount will be ordinary gain under Section 1245. That is
Yes. So there
55,000.
is no capital gain here at all. All profits will go as regular income. Here, the profits we can still split up and see what can be taken advantage as capital gain income. Let's go over some of the. Yeah, they have some example here. Okay, so these are the examples that we went over. These are the two situations when the gain is more than the depreciation taken, and here the gain is less than the depreciation taken. Right? So now this example will probably help us understand depreciation recapture. How will section 1231 gain be computed? Okay, let's look into it carefully. This is a very good pictorial representation of what we have just learned in these two examples. And here 40,000 is the adjusted basis, okay, for all these three situations. And $100,000 is the historical cost. So we will see what is section 1245 recapture. Now in example 10.8, we said amount realizes 105,000. How much is the basis? 40,000. How much was the depreciation taken? 60,000. 40 plus 60 is 100,000. But the amount realized is 105. So we have a gain of 5,000 here. Here, amount realized or the sale which is happening for that business property which is being sold after 1 year is 95,000. Basis is still same, 40,000. But the gain is not enough to cover up the entire recapture amount, because how much is the gain here? 55,000, right? Here how much was the gain? 65,000. So we could take entire 60,000 as section 1245 recapture, because 60,000 was the depreciation this was claimed. This is all a thing is only for depreciation. We can take on top of that whatever is left, we'll say that, okay, this is section 1231 gain, which is coming up at a special capital gain rate. But here there is nothing coming up. We are not even able to cover up, our section 1245 or depreciation amount. So fine, whatever is there, 55,000 is the total gain, and entire amount will come up as ordinary income. If the amount it passes this line, 100,000 of historical cost, then we have to see if there is a section 1231 gain. The cost was 100,000, it got sold for 105. Here the cost is 100,000, it got sold for 95,000. There's no question of section 1231 here. Sorry, someone was asking something.
I have a question. What if the property is sold for loss? So the whole thing will be, the loss will be recognized as ordinary loss under 1231.
Yes.
Oh,
Yes.
okay.
If 1231 is applicable, yes, then yes, ordinary, all the losses will come up as ordinary losses. Okay, let's quickly go over this. Sale of business use assets held for 1 year or less. 1 year or less. If there is a realized gain or loss, gain is ordinary income. Loss, if there is a loss, we have to see if it's buyer related, recognized or not recognized. Meaning buyer related, meaning it could be like a asset which was gifted or inherited and all. So it could be recognized. It could not be recognized. We have seen that if it's related party and all, the loss was not recognized, or it could be taken as an ordinary loss if it's not, because it is held for 1 year or less. So it could be ordinary loss or it could be ordinary gain. These straight away, but when the situation is that business asset is held for more than 1 year, then it gets complicated. Then we have to see how much is capital gain, how much is ordinary gain. See, what we'll do is we'll say if there is a realized gain or loss, realized, if this is a gain, okay, if this is like a buyer related, again, we'll have to see whether it's depreciable property to buyer. If it's yes, then it could be ordinary income to the extent of depreciation taken. If it's no, we'll have to see whether it's personal or real property. Personal property will go under section 1245. Real property will go under section 1250 here. For individual, or section 1231 gain, whatever. We have to see what is the gain here, 25%, but 1231 gain will come up at a lower rate. C corporation, it doesn't matter. Everything will come up at the standard rate. And section 1231 gain, any amount realized above historical cost. Above historical cost, we have seen that if you're realizing the gain above historical cost, then section 1231 will come into the picture. Otherwise, it will be considered as ordinary income. If it's a personal property, if it's a real property, then we'll have to see if we can take advantage of section 1231 gain. Okay, and then we have to go with our rules. So we'll stop here now.